Thank you. Let me start by thanking warmly the Bocconi University and Goldman Sachs for inviting me and share with you essentially the role that the EIB is playing currently to restore growth in Europe. And let me start just by spending some minutes to understand why we are here discussing on how infrastructure could be used to restore the development of infrastructure can become a tool to restore growth. And why we are discussing currently of project bonds. And in order to do so, we need to go back 4 years. So let me spend just 5 minutes on this issue. What happened in the last 4 years? We had a crisis in 2004, which was a crisis, mainly a financial crisis, generated by the failure of the originate to distribute business model and by years of underestimation of credit risk. And that crisis has hit in particular those EU countries with deep fiscal imbalances or where the banking sector was most severely impacted. However, most countries have experienced a sharp recovery from the 2009 recession and the positive GDP growth in 2010 and 2011. And I mean, this recovery was not at all a given, especially if one compares the crisis in 2008 with the financial crisis at the beginning of the 90s in the Nordic countries, which created a sharp and prolonged drop in the level of investment, so a depression and a recession for a longer period. So this sharp recovery was an excellent result, but how was this result achieved? We saw in 2009, 2010, massive public intervention to support the banking system and contain the credit crunch, and also fiscal stimuli to sustain the real economy. Of course, this happened at a cost. And in fact, the aggregate euro area debt to GDP ratio has risen 20% in the last 3 years, almost reaching 90% at the end of 2011. Therefore, this massive intervention by the public sector, utilized in 2009 and 2010, has reduced the ammunition available in case of a new crisis materialized. Okay. So, after the 2008 crisis, we saw that the European Union was able to respond, to react. And the react happened essentially on 2 fields. The first one was, again, the promotion of an immediate economic recovery and the definition of a long-term strategy. These essentially materialized in two elements. The one related to the short term was the definition of the European Economic Recovery Plan with the ECOFIN of Nice in September 2008. And then Europe worked to define a long-term growth and competitiveness strategy, which is essentially the Europe 2020 strategy, as defined during the spring 2010. But also the European Union worked to reinforce the financial and institutional architecture and governance. I just recall here in the slide the creation of the European semester, the creation of the European System of Financial Supervisors, which implies the creation of the European Banking Authority, the European Insurance and Occupation Pensions Authority, the European Securities and Market Authorities, the European Systemic Risk Board, ending also with the creation of the European Financial Stability Facility. So, to that crisis, Europe reacted, but this came at a cost. But also Europe strengthened its institutional architecture. The EIB was part of the short-term reaction in that time and is also part of the long-term reaction. So it's a key element in the achievement of the Europe 2020 objective. So going back in time, as a reaction to the crisis, the volume of lending by the EIB jumped from 48 billion in 2007 to almost 80 billion in 2009. We focused in particular our activity to support the SMEs, which were the segment of the economy most affected by the credit crunch, and we have financed SMEs throughout Europe for 40 billion in the last three years. We developed new products in particular to support research, development and innovation projects, which usually are the one the kind of investments which are reduced during a crisis. We developed a new instrument to support research and development and innovation in the transportation industry, aiming also at reducing pollution. And we also developed stronger ties with public promotional institutions, such as Cassa Depositi e Prestiti, KfW, Caisse Dépôt et Consignation. And we created a long-term investors club in order to coordinate our efforts in order to provide long-term financing to the project that was needed at the time. Now, we have a new crisis. The 2011 sovereign debt crisis presents by far more complexities than the 2008 crisis. It's not a financial imported crisis, but rather a European Union endogenous crisis, and in particular a crisis of the euro area, whose management implies, and we are experiencing this in these very days or these very hours, implies difficult political choices by the European Union leaders. And the reasons for those crises, I imagine you're aware: lack of economic growth, asymmetric competitiveness of European countries, which impacts the economic performance of the various member states, doubts by the financial markets on the robustness of some EU countries' public finance, doubts on the solidity of some EU countries' banking and financial systems, and also, probably from the investor's point of view, difficulties in understanding the EU, and in particular the Eurozone's governance strategy and long-term objectives. But if you look statically at the euro area, the aggregate figure shows that the euro area is no worse than other area. So here you have the data of the public budget balance as percentage of GDP, and the aggregate of the euro area expected for 2012 is slightly above 3%, which is much lower than other comparable areas. The same applies to public debt on GDP ratio. So it is clear that it's not the static aggregate figure, but probably is this aggregate solidity hides a strong dispersion inside. And the fragility of some countries, and probably also the political difficulties in managing the crisis, have generated the fear of a breakup of the Eurozone as such. But so, if you look statically at this figure and you understand that Europe, the euro area, is not worse off, probably what is lacking is growth. So the low confidence in the EU ability to grow is currently the major criticality. And as of today, however, given the difficult conditions of the financial sector in many member states, a large part of the most urgent measures are of a monetary nature. So infrastructure is a response which might have impact in the short term, but that will deploy its effect mostly in the medium and long term. So here I list some of the measures of monetary nature which are needed. So support to local financial sector, increase liquidity available for the real economy, revitalize the interbank market, review some regulatory aspects. However, also in this crisis, as well as in the 2008 crisis, the role of long-term lenders, such as the EIB, might be an important part of the response. Of course, it will not be alone the response, but it will be a piece of a greater puzzle. Let me show for you, those of you who do not know what the EIB is, essentially, let me spend some time on explaining what the EIB group is. The EIB group is made of the European Investment Bank, which deals with debt financing and indirect equity in financing in infrastructure. So we participate to equity funds investing in infrastructure. And then the European Investment Fund, which is focused on activity in supporting the SMEs. In particular, it acts as a fund of funds investing in venture capital and private equity funds, and then it offers guarantees on SMEs loans portfolio. If you look at the priority of the European Investment Bank within the European Union, you can see that trans-European networks is one of the 6 priorities of the bank, together with cohesion and convergence, the support to SMEs, contribution to the environmental sustainability, the support to RDI, and the provision of energy. Just to give you some figures, last year we have financed 61 billion projects worth for 61 billion. 54 billion were investments that were financed in the European Union, and the rest in the neighborhood country, which means essentially the Southern Mediterranean, the Eastern Partnership country, so Russia and the other countries, and then we have major activities also undergoing in China, India, and Latin America. The net income last year was 2.3 billion. We are, together with KfW, one of the two largest supranational borrowers. And last year we issued bonds worth 76 billion. And at present we have a total outstanding financing of 480 billion, more or less, and this makes the European Investment Bank the largest international financial institution in the world. The other part is the European Investment Fund. Just two figures. Last year we invested 1.1 million in venture capital and private equity funds, and in guarantees and microfinance over 1.5 billion. And at present we have a portfolio in the venture capital and private equity of around 6 billion in 351 funds, and in terms of guarantees, 4.4 billion in 221 transactions. Going back to the current crisis, as a response to the current crisis, the EIB will pursue the Europe 2020 strategy objectives, and in particular we will focus on reactivating investment in infrastructure by developing new financial tools to cover the existing market gaps. And this, as you know, has a produces a short-term effect, which is a stimulus to growth, by activating the well-known mechanisms of the national income multiplier and investment accelerator, but also produces long-term effects by increasing the competitiveness of the European Union. So investment, the financing of investments will be one of our response. The second one will be the support to SMEs, which represents 98% of the European enterprises, and this again will produce a short-term effect of providing SMEs with a source of funding in a moment of credit crunch, but also acting in the long term counter-cyclically in order to support employment. The third area on which we will be focusing is the support to research, development, and innovation, so to ensure the long-term competitiveness of European Union companies. But let me start on the infrastructure. Professor Gatti already mentioned the amounts at stake here. And the implementation of the Europe 2020 strategy implies the implementation of digital networks, energy networks, transportation networks, and the amount at stake is very relevant. I mean, if we add the amount, the infrastructural need for the period 2014 to 2020, we reach 1 trillion euro for these three segments. But then, I mean, those are the infrastructure with the European relevance. One shouldn't forget, and this also was mentioned by Professor Gatti, the infrastructure which are very relevant at local level, but they are not part of the trans-European networks. So other substantial amounts should be added to this quite relevant amount. So looking at the original model, the traditional model, in many European countries, Italy included, in the traditional model, the public sector identifies and projects the public goods to be built, funds the investment through the public budget, and select the constructor. Nowadays, as you can imagine, this modality is suffering because of the poor conditions of the public finance in many countries. I just told you before how the debt to GDP ratio in many countries of the euro area has sharply increased in the recent years. The other options is, of course, the PPP, public-private partnership, is a system in which the private partner projects, builds, finances, and manages a public service under the framework of a contract or a concession from the public sector. So in this scheme, the funding sources for the private partner are typically the banking sector and the capital markets. But as again was mentioned before, if you will look at the banking sector, the lending volume is diminishing during the crisis, and the banks are now facing new constraints, some of which deriving from the regulatory requirements, and I think of the EBA regulation and the Basel III rules. So if we look at the second source, typical source of funding, which are the capital markets, we see that before the crisis, an important funding sources were the securities covered by guarantees provided by the monolines. After the monolines disappeared, this instrument is no longer available. However, we think that many investors seem to maintain appetite for long-term securities linked to infrastructure because they can match their liabilities. So the project bond could be one of the answers, could cover this need, allowing at the same time for the financing of infrastructure without any recourse to the public debt of the involved countries. Let's deviate 1 second from the description of the instrument and let's analyze the PPP market in Europe and in Italy in particular. PPP remains an important technique of implementation and financing of investment, but is now feeling the effects of the crisis. So in the recent year, the volume of PPP in Europe has decreased, and during 2010, those are the latest data we have available, 112 PPP operations reached the level of financing, or the level of financial closing for a corresponding volume of 18 billion euro. In Italy, only 2 operations managed to reach the financial closing in 2010 for a volume of only 0.4 billion. Compared to Spain, the United Kingdom, Italy shows a high mortality rate of medium to big projects. And this leads me to one reflection, which I shared with some people here some days ago. In Italy, essentially, it is difficult to adopt the PPP model for large investments, and in particular for those investments where decision-making process becomes too cumbersome, when delays accumulate, and typically this happens when too many decision-making and public bodies intervene in the procedure. So in this respect, I think that the new legislative framework recently adopted by the government is a very important element and contributes, we hope, to reducing uncertainties on timing and costs for the construction of infrastructure. And I fully share what Professor Gatti said. I mean, this is a precondition. We can talk about project bonds, but project bonds are just a tool to finance bankable projects. If we do not have bankable projects, I mean, let's not waste time in discussing project bond. We first need a solid infrastructure, legal infrastructure, to allow the attraction of private investors. So the project bond is only one tool. The assumption is that we need this legal system in place. Let me move to the description of the project bond initiative. This is a work that the EIB has done together with the European Commission. The possible EIB intervention can happen in 2 ways. The first one, which is on the left, is in a funded way, and the second one is in an unfunded way. So based on the type of project, the EIB intervention has the scope of enhancing the credit merit of the senior bond issued by the SPV up to a minimum rating level of A-. Of course, we are very happy to know that also lower rating can be acceptable for long-term investors. Again, this sort of credit enhancement may happen both in a funded way, so therefore by creating a tranche which is subscribed by the EIB, but also by creating a guarantee which is transformed into a subordinated tranche in case the project is underperforming. So this is essentially the role of the EIB. Now, what is the role of the European Union? The European Union will intervene in the project bond initiative through a risk-sharing mechanism with the EIB on a basis of a portfolio of projects. Therefore, imagine a portfolio of projects made in this way, in which the EIB assumes relevant risks. And in this portfolio made of this small subordinated tranche, we will be sharing the losses together with the European Union. Needless to say, this will allow the bank to multiply its intervention by reducing the capital consumption of the EIB. Therefore, this risk-sharing mechanism with the EU will allow the bank to intervene more frequently and to multiply its contribution. In the context of the project bond initiative, the EIB has decided to go for a tranching approach, not a wrapping approach. Therefore, will not adopt the traditional monolines model. We will not provide, via the wrapping, a comprehensive risk coverage that would allow to reach the AAA rating, but we will grant a guarantee instrument on FAD or a subordinated loan for a limited amount that would be sufficient to strengthen the financial structure and allow the bond to reach the investment grade rating. Here again, I mentioned in the slide A-, but happy to know that also lower ratings still in the investment grade domain are acceptable. What DIB will bring to this initiative? The attractive pricing which it is able to offer, its reputation, its long experience in the screening, assessment, and monitoring and risk mitigation of projects. We think that the credit enhancement provided by the EIB could reach 20% of the senior debt of the projects, so to assure a protection of the debt service for the majority of the scenarios during the project life. One element which is important, of course, is that the subordinated debt provided by the EIB should not and will not be considered as a substitute to loans or equity contributed by the shareholders, which will be needed at the level requested by the market. Then, to some corollary to this kind of intervention, we think that it might be very useful to exploit the synergies with other instruments that have been created recently, especially to intervene on the equity side of this key infrastructure, and I think here of the Margaret funds, where the EIB and Cassa Depositi and Prestiti are important partners. But also we are willing to cooperate with other long-term investors also in developing this initiative. And, but the key assumption, again, is that the projects must fulfill the usual EIB evaluation criteria, so they need to be technically and financially sound. And again, the regulatory framework must be clear and stable. And this is, again, the precondition that I think will be the most important. So I've explained how we think that we can contribute to the infrastructure, to the development, again, to the restarting of the financing to key infrastructure in Europe. Allow me to spend 2 minutes on another important area on which we will be focusing, is the support to SMEs, also because we think that this is a crucial part of the response we need to give. And here I want to share with you one initiative in which we are thinking. We have created together with the European Union what we call the risk-sharing instrument, and this again goes in the same logic of the project bond initiatives, which is to share risk. So we think that the EIB group could identify a portfolio of projects financed by a bank, or that the bank is committed to finance in the next 2 years, related to research for innovative and research-oriented SMEs and small mid-caps. So we will guarantee 50% losses incurred in each loan, but we will ask the financial intermediary to retain 20% of the economic exposure through the entire loan life. Here, if you think the logic is exactly the same, to try and share the risk with the European Union in order to multiply the effect. And needless to say, the effect of this kind of intervention is also to relieve the capital consumption of the banks by transferring some risks to the European Investment Bank. And this is why we think that financial intermediaries will be interested in this project. Of course, we are also thinking of new instruments that can be developed in order to support the lending of the EIB to counterparts which are more riskier, and these also implies the creation of funds which will be bearing the first loss piece in a portfolio of investment. So I just wanted to spend 2 minutes on the SMEs because I think that this is also a crucial segment that Europe cannot ignore in a moment in which it's discussing about how to fuel the growth, because the credit crunch is there, because in some countries we do not have a lack of infrastructure. I think especially of Spain and Portugal, where massive investments have been done in infrastructure. So infrastructure is one of the answers, but also we have to take into account the other part, and the most relevant, of course, also for the contribution it gives to employment are the SMEs. The current challenges for the EIB is to contribute to the European Union recovery in a much riskier environment while preserving its top rating. And you shouldn't forget that the EIB is both an institution but also a bank, a AAA rated bank. And the other challenge is to deploy new financial instruments aimed at fostering the European Union growth and competitiveness while sharing risks with the European Union, so to consume, again, less capital and therefore multiply the lending capacity. We just discussed the EU Project Bond Initiative and the risk-sharing finance facility and risk-sharing initiative aimed at supporting investment made by innovative SMEs and mid-caps. As you are aware, there are ongoing discussion, and our political master will decide on a possible 10 billion capital increase of the EIB, so to allow it to increase its level of activity while still retaining the AAA rating, which is a precondition for our business model. Let me just leave you with, by recalling that those are, as you know, crucial days, let's say crucial hours for the future of Europe. And therefore, I think that a final message of hope or realism is needed today. And I have found a very interesting message from Giuliano Amato, which is a person who knows quite well the European Union, having been the deputy chairman of the EU Convention. And I don't know whether this is a message of hope and realism, and it's in Italian. L'Europa avanza scegliendo quasi sempre la strada sbagliata dopo aver accuratamente scartato quelle migliori, ma sia pur di traverso avanza. Speriamo che sia così. Grazie.